Imagine waking up one day to find you've earned a staggering 1 million within a single year from the stock market. Sounds like a dream, right? But what if I told you it's achievable? The stock market's potential can grant you financial freedom. Today we'll be diving into this world guided by Arthur Lee Simpson's wisdom in his book, Phantom's Gift. Stay with us as we unravel the secrets of the stock market. Arthur Lee Simpson, a financial guru, has penned down his wisdom in Phantom's Gift. A mastermind in stock trading, Simpson demystifies the financial market's intricacies in his masterpiece. This book is a beacon for those navigating the tumultuous waves of the stock market. Let's dive into the richness of this book and unlock the key to financial freedom. The first secret from Simpson's book is simple yet profound. Change your behavior or fail miserably. This powerful premise introduces us to the idea that our actions, our behaviors, and our attitudes towards the stock market can either pave the way to financial freedom or lead us down a path of financial disappointment. Now you might be wondering, what behaviors are we talking about here? Well, Simpson refers to our investment habits, our decision-making process, our risk-taking propensity, and our emotional responses to market fluctuations. Let's start with investment habits. Are you the type to jump on every hot tip or trend? Or do you meticulously research and analyze before making a move? Simpson emphasizes the importance of disciplined, informed investing over impulsive decisions. It's about making calculated, educated choices rather than taking wild shots in the dark. Next, we have the decision-making process. Are you consistently reactive, swayed by market rumors and hype? Or are you proactive, developing a well-thought-out investment strategy and sticking to it? Simpson advocates for the latter, advising us to create our own market narrative rather than getting swept up in the crowd's story. Risk-taking propensity is another key behavior. Are you a risk-averse investor, shying away from high-risk, high-reward opportunities? Or are you a risk-taker, willing to embrace volatility for the chance of higher returns? Simpson doesn't promote one over the other, but rather stresses the need for understanding your personal risk tolerance and investing accordingly. Lastly, there's the emotional response to market fluctuations. Do you panic when the market dips, or do you see it as a potential buying opportunity? Simpson counsels us to keep our emotions in check, to not let fear or greed dictate our investment decisions. So, if you want to succeed in the stock market, heed Simpson's advice. Evaluate your behaviors, recognize the ones that are hindering your success, and make the necessary changes. Because, as Simpson suggests, adaptability and behavioral change are the stepping stones to stock market success. The second key point from Phantom's Gift is to close incorrect positions promptly and cut losses. Now, this is a principle that can make or break your success in the stock market. Minimizing losses, you see, is a crucial aspect of trading that often gets overshadowed by the glitz and glamour of profiting. Think about it this way. You're investing your hard-earned money into the market. It's a battlefield out there, and every dollar you invest is a soldier in your army. Just as a wise general wouldn't throw his soldiers into a losing battle, a smart investor doesn't cling to losing positions. So what's the secret? Quick decision-making. Arthur Lee Simpson stresses the importance of swift action when it comes to closing incorrect positions. This might seem intimidating at first, especially when you're hoping the market might turn around. But let's face it, hope isn't a strategy. Not in the stock market, and certainly not in war. Now, don't get me wrong. I'm not saying you should panic every time a stock dips a bit. It's about understanding when a position is genuinely incorrect. This could be due to a variety of factors, such as a change in market trends, a company's poor performance, or geopolitical events that could impact the sector. Once you identify these factors and realize that your position is incorrect, it's time to retreat, regroup, and re-strategize. Remember, every dollar saved from a losing position is a dollar that can be reinvested. And the beauty of reinvestment is that it gives your money a chance to grow again. It's like giving your defeated soldiers a chance to heal, regroup, and fight another day. So let's take a leaf out of Simpson's book. Let's be more attentive to the signs of a losing battle. Let's be swift in our decision-making and brave in our actions. Because in the grand scheme of things, it's better to lose a battle and save your army than to lose the war. Remember, minimizing losses is just as important as maximizing gains. Because at the end of the day, the stock market isn't just about winning. It's about surviving and thriving, no matter what the market throws at you. Now, let's compare Phantom's Gift with the famous turtle trading rules. In the world of stock trading, strategies are as diverse as the traders themselves. Two such strategies are the Phantom's Gift, introduced by Arthur Lee Simpson, and the Turtle Trading Rules, a time-honored strategy by Richard Dennis and William Eckhart. Phantom's Gift focuses on altering behavior, minimizing losses, and capitalizing on explosive volumes. It's a dynamic strategy that adapts to market changes, emphasizing the importance of strategic exits and the power of explosive volume. Simpson urges traders to close positions if they are incorrect, reducing losses, and to increase bets when the market is favorable, maximizing profits. On the other hand, the Turtle Trading Rules are a classic trend-following strategy that was born out of an experiment by Dennis and Eckhart in the 1980s. The rules are straightforward. Buy when prices increase above their recent range and sell when they fall below it. This strategy is more about patience and discipline, holding on to positions for as long as the trend continues, regardless of short-term fluctuations. Both strategies have their pros and cons. Phantom's Gift, with its emphasis on flexibility and swift decision-making, might suit the more active trader. It demands a keen eye on the market and the readiness to act decisively. The Turtle Trading Rules, meanwhile, might appeal to those who prefer a more measured, patient approach, comfortable with riding out the market's ups and downs over a longer period. However, it's important to remember that no strategy is foolproof or guaranteed to bring success. Both require discipline, a solid understanding of the market, and the bravery to make tough decisions. While both have their merits, Phantom's Gift provides a unique perspective on stock market trading. It's a fresh approach that combines traditional trading wisdom with Simpson's own insights, offering traders an alternative way to navigate the often unpredictable waves of the stock market. So, whether you're an experienced trader or just starting out, there's always something new to learn and apply to your trading journey. The fourth key point from Simpson's book is the key to profit is to increase your bets. Now, this might sound a bit counterintuitive. After all, isn't the stock market all about playing it safe and diversifying to minimize risks? Well, this strategy takes a slightly different approach. The idea here is to leverage the power of compounding. It's like a snowball rolling down a hill, gaining more and more momentum. As you see positive returns on your investments, you reinvest those profits, effectively increasing your bets. This way, your profit isn't just a flat rate, but it grows exponentially over time. However, this strategy isn't without its risks. As we all know, the stock market can be unpredictable. There are good days and bad days, bull markets and bear markets. When you're increasing your bets, you're also increasing your potential losses. This is why it's crucial to have a solid understanding of the market and to keep a close eye on your investments. Consider this strategy as a high-stakes poker game. You're not just blindly throwing your chips into the pot. Instead, you're calculating your moves, reading the market, and making informed decisions. When you see an opportunity, you strike. You increase your bet, and you reap the rewards. But remember, just like in poker, you should never bet more than you can afford to lose. This isn't about gambling away your life savings. It's about calculated risks, strategic moves, and smart investments. So, how can you start increasing your bets? Start small. Test the waters. Get a feel for the market and understand how it moves. Once you're comfortable, you can start upping the ante. Little by little, step by step, you'll see your profits grow. And remember, this isn't a get-rich-quick scheme. It's a long-term strategy. It requires patience, perseverance, and a whole lot of nerve. But if done right, the rewards can be immense. As the saying goes, you have to spend money to make money. And with this strategy, you're not just spending money. You're investing it, growing it, and turning it into a powerful tool for financial freedom. Finally, Simpson highlights that explosive volume is a great opportunity to cash out. Now, you might be wondering, what is this explosive volume that we're talking about? Well, in the simplest terms, explosive volume is a significant increase in the number of shares traded for a stock or commodity. It's like a sudden burst of activity that shakes up the market. The concept of explosive volume is a game changer. Why? Because it's often associated with significant news events or changes in an enterprise, leading to a drastic change in the stock's price. It's the market's way of telling you, hey, something big is happening here. Now, Simpson doesn't just tell us about explosive volume. He gives us a strategy, a method to navigate this stormy sea. He suggests that when you see the volume of a stock explode, it's time to prepare your lifeboat and get ready to abandon ship. But don't just jump out at the first sign of trouble. No, Simpson advises that we should exit the position within 3 days when the volume explodes. Why 3 days? Well, it's not an arbitrary number. It's based on Simpson's extensive research and experience in the stock market. He found that after an explosive volume, the stock price often stabilizes or even drops after about 3 days. So, by exiting within that time frame, you're likely to maximize your profits and minimize potential losses. But here's the catch: timing is everything. You need to keep a close eye on the market, monitor the volume of your stocks, and be ready to act when the volume explodes. It's not about predicting the market, but about responding to it. It's about being agile, being smart, and making your move at the right time. So to sum up, explosive volume is a signal, a beacon in the vast ocean of the stock market. It's an opportunity to maximize your profits, and it's an integral part of Simpson's strategy. Remember, timing is everything in the stock market. Let's take a moment to recap the wisdom we've gleaned from Phantom's Gift. Arthur Lee Simpson, our guide on this journey, implores us to change our behavior or risk failing miserably in the stock market. He insists that if we find ourselves holding on to an incorrect position, we must close it swiftly to minimize losses. We've compared the Phantom's Gift strategy to the turtle trading rules, learning that both have their merits. Simpson emphasizes that the key to profit is not being afraid to increase our bets when the odds are in our favor. Finally, we learned about the power of explosive volume. When the volume of a stock explodes, it's a signal to cash out and exit the position within 3 days. Remember, the road to financial freedom is not easy, but with the right strategies, it's certainly achievable. Can't wait to meet you guys on the success road. Don't forget to subscribe, like, and share this video with your friends and family.